Hello, and welcome to The Pitch. Our guest today on the show wrote a wire on the Livewire website back in July and titled, quote, "A pullback in Australian consumer spending could last years." So, to find out whether this has come true and what he's doing with that information, I am delighted to say we are joined by the author of that wire. He is Casey McLean of Fidelity International. Casey, just to start with, can you take our viewers and readers through that key view from back then and how have your views evolved since then?
Sure, Hans. Well, to recap, we think the Australian consumer is going to be under pressure for a number of years, and that's really driven by a few views. Firstly, we think interest rates are going to be higher for longer. Inflation is proving more sticky than expected, especially service inflation, so we think it's going to be later and probably less of an interest rate cut than most people are expecting. Secondly, we think there's weakness coming in the employment market. If you look at job ads, they're declining at the fastest rate since the GFC, if you include the brief COVID blip there. And that generally is a leading indicator that says employment is going to soften. Thirdly, the excess savings that a lot of consumers built up over the COVID period when the government gave out all these stimulus checks, most of that has been run down. And in fact, if you look at the breakdown by age, it's only those people over 55 that are still seeing their savings balances rise. Everyone under that is seeing declines in their savings balances, and it's having a commensurate effect on their spending as well. And finally, we think migration is going to be curtailed, and that has been a big tailwind to consumer spending over the last few years. So as we sit here today, none of those views have changed. Those drivers are still in effect, we think.
So I take your point around the seat job ads and that weak consumer argument and all the nuance within that, young people struggling a lot more than older people. As somebody who is in his mid-20s, I completely concur, incidentally. But there are also some economists that say, we've hit the low for retail sales and we're starting to see consumer and business confidence tick back up. Of course, all of those are key leading indicators for identifying those consumer-related opportunities as well. But I'm curious whether you agree and, how much would a shift in psyche influence your investment choices?
Yeah, no, I understand what you're saying, Hans, but if we look at the data, I don't think it's suggesting that. In September, we saw retail sales rose by about 0.1%. That comes after a 0.7% increase in August and zero in July. And that's meant to be in this period where the tax cuts come through and really lift consumer spending. And remember, these retail sales, that includes the effect of inflation. It includes the effect of migration. And if we are to take these factors out and look at retail volumes on a per capita basis, they declined by 0.1% in the September quarter. And that was the 9th consecutive decline in that measure, which is suggesting it's pretty broad-based. And that's coming to light in company results. In the last month or two, we've seen a wide range of consumer companies downgrade their earnings outlooks or miss expectations, both in the consumer discretionary segment. We've seen the likes of Nick Scali, Super Retail and Flight Centre. And even in the staples segment, we've seen Woolworths, Endeavour and Domino's Pizzas. So that suggests to us it's pretty wide-ranging, this consumer weakness.
Absolutely. So, but I also note, though, that your fund has a much greater weighting towards, discretionary stocks over staples. Why such a big preference for this area, and what are some of those resilient consumer stocks that you're eyeing?
Yeah, so the nuance there is a lot of our exposure in consumer discretionary is not to retail. It is to the likes of gaming, which is also in that sector. And the few discretionary stocks that we do hold are what we would consider ones with structural growth opportunities. These are companies that have ample white space to roll out new stores, which is going to drive their growth going forward as well. But for pure domestic-focused consumer discretionary, that is an area that we're definitely underweight.
Yeah, okay, absolutely. So, listen, finally, I was looking at some stats for consumer stocks on the ASX very recently. Discretionary index is up something in the neighbourhood of 23% in the past 12 months. Staples index has essentially gone nowhere. Do you think now is the time to sell your discretionary holdings and pick up, say, the supermarkets or the staples instead, or is not necessarily?
Actually, I don't think it's the time to own either the domestic discretionary or staples retailers. And if you look at the consumer discretionary sector, like you said, that's done very well. It's been driven purely by a re-rating. The sector's now trading on about 25 times PE. That's well above their long-term average of 17 times, and in fact, at the highest level outside of the COVID period. At the same time, the earnings for the sector for 2025 have been cut by 5%. So we don't think it is a good outlook, good risk reward for that sector. But in the staples, at least the key segments in supermarkets and also liquor retailing, you have the pressure of deflation in food and beverage prices, and also the additional pressure from the ACCC review into supermarket pricing as well, which is going to probably add to increased pressure on their top line at a time when costs are not really abating. Labour cost is the key input, and that's still rising as well. So, with the exception of very few companies, we think it's a sector to avoid for now.
Right, some really interesting thoughts there. Thank you. That's Casey McLean of Fidelity International, and thank you for joining us as well. If you enjoyed that interview, you can subscribe to the Livewire Markets website as well as our YouTube channel, where we are adding great content all the time. We'll see you again soon. Take care.